Warm greetings to all the learners of Dr. B.R. Ambedkar Open University. Today we shall be discussing from your Block 3 Introduction to Business Finance, Unit 3 Financial Planning Nature and Scope, the lesson on Nature of Financial Requirements. Now basically what happens is when business is running, you have different types of financial requirements which are there. So in today's session we shall be talking about why financial planning is important, what type of financial requirements are there in a company, how do companies go about planning for their finances, what are the various tools which are available when you talk about financial planning. Those tools and can also be in the form of different statements like cash budgets, income statement, balance sheet, and then when companies take up these financial planning, there are also bound to be certain limitations. So then we will also talk about limitations. So this will be the scope of discussion in today's lesson. First, let us begin with what is the meaning of financial planning. Now, financial planning is undertaken equally by companies as well as by individuals. So, when you talk about financial planning, the connotation or the meaning of financial planning will be different for a company and then for an individual. When it comes to a company, a financial plan is nothing but a statement. In that particular statement, you are trying to estimate what is the amount of capital which is required by the company and what is the composition of that particular capital. We all understand as students of commerce the meaning of the word capital. So, when the company requires huge amount of resources, especially financial resources to do their operations, those resources have to be sometimes raised on your own where the promoters of a company contribute. Sometimes you have to borrow the resources from different sources and also issue shares to people who subscribe to their shares and become the owners of the company called as shareholders. All this put together, that is the owner's fund, borrowed funds, all put together will be called as capital. So, in financial plan, it is nothing but a statement which will talk about how much amount of capital is needed by the company and what all is comprised in that particular capital. How much will be your own funds, how much will be the funds which you will take from all other sources. So, estimating amount of capital needed and composition of that particular capital is nothing but a financial plan. So, a statement which will talk about how much capital is needed and what all is comprised in that capital is called as a financial plan in simple words. Now, in that particular financial plan, you have different aspects which you have to focus upon. Firstly, you will talk about how much money is needed. So, what is the fund requirement? For example, if the company is already an existing company and you are talking about expansion, say from one unit you want to expand to another unit or another branch. So, for that particular expansion, you may be requiring money. So, how much of fund is needed for that particular activity? So, that will be one aspect, how much fund is required. Second is, when is the fund required? When are you going to operate that new branch or that new unit, and from when will the operations begin? So, that way the fund is needed when? Is it needed immediately or after 6 months or in the next financial year? So, the decision related to when is the fund required. And how will the fund be raised? From where will you get that amount? Are you going to borrow from banks, financial institutions, issue share capital and take from shareholders, or go to a foreign market and raise the money? So, that way you will talk about how the fund will be raised and how to use the fund. Once the fund comes into the company, then how are you going to administer that particular fund also becomes very essential. So, in your financial plan, no doubt it's an estimation about amount of capital needed and how it will be comprised of, but it will also take into account all these aspects in terms of how much fund is needed, when is needed, how are you going to raise it, and how is the fund going to be utilized. This is basically what is the meaning of financial planning for a firm or a company. Coming to individuals, a financial plan is nothing but a in total or a comprehensive evaluation of an individual's current pay. How much is the current pay of that individual? That is the current income source of that individual, and what will be the future financial status. And you are going to predict the future financial status based on some current variables like how much is the income, what are the assets owned by the person, what kind of requirements the individual may have. So, based on a thorough evaluation of the current position of the individual and the future expectations in terms of what all may be the sources of resources in the future income and where all will this income be applied, which is expenses. So income and expenses you will take into consideration, and then you will do an evaluation of the person's current financial position to predict how much is needed in the future. That is for an individual. But because of students of commerce, we will first basically talk about financial requirements of a company. Financial planning for an individual will take a back step, where because from individual to individual the requirements may differ, but for the companies usually the requirements will be uniform as such. Now let us come to what is the definition of financial planning. Now financial planning, as I said, it is nothing but a process of estimating capital requirement and how will that capital be comprised. It will also talk about all financial policies of the company. Now those financial policies will take into consideration procurement, investment and administration of funds. These three things will come into picture. Procurement, from where will you get the money? Then investment. Once the money comes into the company, once the fund is raised, how are you going to invest? Because company may have different operations. In which operation will you invest? And once you have planned to invest in a particular operation, how are the funds going to be administered for that operation? At what level, how much money will be released, and how are you going to administer the progress of the utilization of that particular fund? So that way you will talk about procurement, investment and administration of the fund for an enterprise in terms of financial planning. Let us see a perfect definition given by Cohen and Robbins for what is financial planning. Cohen and Robbins talk about financial planning by highlighting 5 factors in it. They talk about determining financial requirements of a company so that the company can chalk out their operating program. So how much fund is needed for me to run an operating program? So determine is the first thing. Second is forecast. Forecasting the extent to which these requirements will be met by internal funds, because the company may be having in past reserves and surpluses, or they may be a facility of generating internal resources. Internal funds can be generated. So whether you are going to meet these requirements from the internal resources itself, or are you going to borrow from the external sources? So after determining the need, now you forecast whether you are going to make use of the internally generated funds and then carry on the activity, or whether you will borrow from external sources and then do the activity. That is the second. Third is develop. Develop the best plan in order to obtain external funds. See, external funds are available from different sources. A bank may charge a certain interest rate, a financial institution may charge a certain interest rate. If you are raising money through a capital market, your obligations are different. So when you have different sources, you have to assess from which source is it feasible for me to raise that particular amount. So therefore you will develop the best plan to operate the required external funds which are there. Then you will also maintain a control over the utilization of fund, because simply generating money for a particular purpose, it may become easy because you have several sources of raising money. But once that fund comes to you, how are you going to maintain a system of financial control? That is also very essential, because the company will have to govern the allocation and the use of funds. Unless it does that, there will be a complete misutilization of funds, whereby it will add up to the liability of the company. So the companies will have to be very careful, not only raise money, but at the same time exercise financial control, so that the money that is being raised is put to proper use as such. So therefore you have to establish financial control. Then you have to formulate programs so that there is effective profit, volume and cost relationship. If I spend this much of money on an activity X, how much volume of profit will I generate? How much will be the level of activity, and what profit or revenue will be generated from that activity? So you will have to kind of do, cost benefit analysis or profit volume cost analysis. If I am investing, say for example, if I am raising for instance 1 crore through a financial institution, out of that 1 crore, if I am administering to an activity, say for example 45 lakhs, if 45 lakhs is administered to an activity, what is that 45 lakhs capable of generating in terms of revenue. So, if I have applied 45 lakhs to an activity, it should be capable of giving me return as such. Only then I will be having the ability to repay the money which I have raised. So, therefore, you have to do a profit, volume and cost relationship, and then you analyze the financial results of the entire operation. So, Cohen and Robbins in this definition very comprehensively, very holistically, they have defined financial planning and said that you are determining, you are forecasting, you are maintaining financial control, you are formulating and you are analyzing plans for your business. So, that is in terms of Cohen. Another definition by Walker and Bohan, they say that financial planning is the only function of finances and it includes firms' financial objectives, financial policies and financial procedures. So, what is the policy for me to raise money, administer that money, get returns out of that money is all about financial planning. Now, why is this financial planning important? So, let us see significance of financial planning. Now, if a company does not take a financial planning, they will not be able to know adequacy of funds. So, to ensure that amount of money in the company is adequate to do the operations, you need financial planning. Financial planning also will assure that there is a reasonable balance between inflow of fund and outflow of fund, so that on no day there will be deficit in the company as such. And financial planning also will ensure to the suppliers that they are investing in a company which is a sound company, which takes care of its finances and takes care of planning for its finances. So, for an investor also, for a supplier of fund also, once they are planning to invest in your company, they have to be assured that your company is not going to misuse those funds and they will repay back. So, how are you going to give that assurance to them? Only when you show to them all financial plans, the statements, and you tell them that this is how we are going to utilize the money that we are going to raise from you. So, that way financial plans will ensure to the suppliers that they are investing in a right company which is exercising financial planning. And for all programs which are related to growth of the company, expansion of the company, long range survival of the company, financial planning is very essential. And also all kinds of uncertainties which may be there in the market, uncertainties which may be there in the business environment, all of those can be tackled very easily if the company has got a financial plan with it, because without planning it will become very difficult to face the uncertainties in the market. So, that way also financial planning will become significant in reducing the uncertainties which are coming in the way of growth of the company. Also, it will speed up the process of raising fund. For example, if a company A has got a plan and they are going to convince the suppliers of fund or the investor that look, we have this plan and we want you to invest in this particular plan. And likewise, company B does not have any plan, but they only want to raise money. So, as an investor, naturally the raising money becomes easy for a company which has a plan than for a company which does not have a plan. So, it will expedite the process of raising of funds as such, and also it will help in fixing all kinds of loopholes which are there in the capital structure. A capital structure of the company will have to be balanced. If a company has got more of owner's fund, then it will become risky for the owner to run the business. On the other hand, also if the firm has borrowed lot of money from outside, then liabilities of the company will be too high. You have to repay that all money which you have raised. So, therefore, to strike a balance in the capital structure of the company, this kind of financial planning will help. So, it will help in raising short term money, medium term money, long term finances from various sources at different stages of company's performance. Same way, it will also build confidence among the investors, because investors will have a look at your financial plans and they will start comparing that you planned to do this with the money that we are giving to you. So, whether you have actually invested or not, the investors can keep you on toes and help the companies to understand whether they are using or misusing the funds of the investors. So, it will boost up the confidence of the investor if a financial plan is well drafted by the company. Also, all kinds of business shocks which can be there, or any kind of positive activity which the business may want to undertake in terms of growth, expansion and all, those all can happen with the help of a financial plan. Now, all this while we are saying requirement of fund to be needed. For what all purposes does a company require fund? So, let us see what are all the nature of financial requirements. The total financial requirement of a firm can be assessed in two broad categories. One is called as a tangible property and one is the intangible property. Tangible property will include current assets, fixed assets. In current assets, we call those assets as current which are capable of easily converted to cash within a period of 1 year. So therefore, all those assets which have the ability of being converted into liquid money or cash is called as a current asset. So your inventory, for example, stock, merchandise, goods that we have, we can sell in the market and raise money. So that is a current asset. Same way, all kinds of, if you have sold on credit, then those creditors are supposed to prepay back to the business. So that also the sales data which we call as. So the company has sold to them and they have not paid in cash, but they have promised to pay after certain time. So when they are promised to pay after certain time, when the time comes, which is usually 3 months plus a grace day of 10, so within 3 months if the payment is being done, that also will be a part of your current asset, which are called as sundry debtors, because they owe to the business when sales happen on credit. Then you have any other miscellaneous current asset which can also be easily converted. So this is first set of assets where the company requires money in order to run their operations. For example, buying inventory, buying raw material, producing finished goods, you require fund for that. So current assets. Second is fixed assets, where you talk about tools, machines, equipments, furniture, fixture, land, building. For all these purposes, the company will be requiring the finances which are there. This is first category where you call as tangible property. Second is intangible investment, where those investments which you cannot see, touch and inspect, but they actually add value to the company in terms of, for example, goodwill of a company, or when you have borrowed money, there is a process cost of that particular money. So you have cost of financing. If the company has created some invention and you are getting it patented, then you have cost of those patents which are there, and then all promotional expenses where cash is required, all of these will be a part contributing to the intangible investment of the company. So a company will require finances for these activities as such, intangible ones and the tangible ones. So the nature of financial requirements will be depending on tangible and intangible activities of a company. Now, when the company takes up financial planning, they take up with two broad objectives. Firstly, ensuring that adequate funds are available, and secondly, that no unnecessary fund raising has been done by the company. If the company is not in requirement of a fund, then the company should avoid raising that fund, because it will add up to the liability of the company. So you have to check that there should be no unnecessary fundraising by the organization, because idle money will not result in any cash inflow. Idle money will only result in addition to the liability of the company. So therefore, care should be taken that there is no unnecessary raising of money. Now, when we say companies take up financial planning, it is not a one-time activity, but there are a lot of steps which are involved in financial planning. The first step is find out what is your current financial position. What is your current position in terms of income, savings, expenses, operations that you have got. For example, if a company is running since 5 years and in the past 4 years they have had extra income, that is reserves and surpluses, then can the company tap money from those reserves and surpluses instead of raising money from an external source? Because if they raise from external source, it will add to the liability. Rather, can they make use of their reserves and surplus to carry on the activity in the company? So first of all, company will have to assess or determine their current financial situation, which will be in terms of income, savings and expenses. Secondly, company will have to develop their financial goals. Why is the money required? And with that particular money being used, what are you going to achieve? So whether money is required for expansion, if you expand, what are you going to achieve? Is the money needed for buying a new machine? If you are buying, then what is the goal achieved? Is the money needed for investing in technology or AI purposes? Then what is the result of that particular activity? So for every amount of investment that you raise and that you do, you have to find out what are your goals behind that particular activity. Then you identify alternative action, because during the course of making a decision related to raising of finances, you have several options which are available. So as a company, you will need to assess which option is apt for the company, because some options may be such. For example, sometimes the government also gives subsidies to the organizations to do some activities. So when a subsidy is being given, why raise money from a bank? Because that will add to the interest liability on the company. So rather you make use of the subsidies which are given by the government. So when you have different alternative courses of actions which are available, companies can make use of those alternative courses of action and assess whichever is the best one for them to raise the finances. So identification of alternative action. Then implementing the financial plan. Whatever is the financial plan that is being created, they have to achieve the particular goal, and that financial plan has to be developed and they have to be implemented. Most of the time company also takes recommendation from financial experts. They may have in-house financial committees which will contribute to this particular financial planning, or they can take recommendations from outside financial experts. You also have security market experts, portfolio investors, wealth managers, and then you have got investment managers who help companies to raise the money. So they have to develop a financial plan by taking these recommendations of the experts who are there. Then once the financial plan is actually being implemented, the company will have to be monitoring the progress of that particular financial plan. So identifying what is the progress, reviewing the plan, monitoring the plan regularly also becomes very essential. Not only saying that money is needed for activity X and you are raising the money from partner A, then whether that money which is coming is actually put to the right use or not, that also has to be monitored in the company. Now when you do financial planning, to say it is easier, but to do it is a little difficult, because you will have to make use of certain tools which are there in financial planning. The first tool which is available is budgeting. Preparing budgets for every activity. If the company wants to do an activity of increased production, for example, in the current month the company is producing 10,000 units. In the next 6 months the company wants to increase the production by 5 times. Now when they want to increase by 5 times, they have to prepare a budget. How much is needed for material, how much for labor, how much for factory expenses. So make a budget related to the increased capacity utilization, increased amount of fund, and then justify why the money is required for an increased activity. So that way budgeting tool will have to be taken into consideration. Then you also have to take up a tool of investment analysis, which will help individuals in the company and the company itself to gain valuable insights into risk and return, because every investment option will have certain risks and certain returns associated with that. So therefore in investment analysis, the company will have to undertake risk and return analysis for their entire portfolio which they have got related to their financial plan. Then companies also can make use of the tool of insurance calculators. As individuals, even companies need to have insurance for their properties which are there, for life of people whom we call as key management personnel, KMP. Companies also take insurance policy on their employees, on their key management personnels. They take insurance for their property, for the assets that they have got. So insurance calculators will be there, which will help in determining the appropriate amount of insurance coverage which is needed, which is keeping in mind the current source of income, assets and expenses which the company has got. So that also is a tool of financial planning. Then you have tax planning softwares also which are available, or tax planning tools which will help individuals as well as companies to plan their taxation and to manage and file returns or file taxes as such, so that money can be saved, and at the same time how you are making use of the funds as such, so that you don't incur a heavier tax liability as a company. So tax planning also will be one tool which will be there. Then for individuals also who are working in the company can take up retirement planning tools which can be there. For all the employees who work in the company, companies can identify factors such as income, expenses, retirement goals, personalized projections and recommendations for their employees, and then they can carry out retirement planning as such. Then companies can also take up the tool of estate planning. There are many softwares and companies which are available which do estate planning, where you talk about a process of creating and managing estate documents such as wills and trusts and all kinds of property documents which the company may be owning. So what kind of legal complications could be there, tax liabilities could be there, all that can be assessed by using this particular tool of financial planning, which is your estate planning. Now coming to different financial statements which are there, which will help in financial planning, because initially we said that financial plan is nothing but a statement. So those statements are of different types. The first type of a statement is called as a cash budget. Cash budget is a precise statement which is talking about projections related to cash receipts and cash payments. A company will have different types of cash receipts and they have to make payments also in cash. Cash in the sense both hard cash as well as bank adjustments which are there. So most of the transactions happen through the bank. So when you have receipts and payments in the form of cash, then you prepare a precise statement for a particular period which is called as a cash budget. So cash budget is a statement which is depicting projections related to cash receipts and cash payments for a specific period of time. In cash budget, you have got receipts such as cash sales, collection from debtors, you have call money which is received on shares, loans which are repaid and sale of capital assets. Similarly, on payment side, you can have purchases which you make on cash, payments which you make to creditors, salaries and wages which you are paying, interest which you are paying, loan which the company repays, taxes which the company repays. Those all will be in the form of cash payments which the company make. This is one statement. Pro forma are also depicted on your screens. Then you have income statement. Income statement is nothing but a statement related to profit and loss of the company. How much revenue is generated by the company and what all expenses the company has incurred, because excess of income over expense is nothing but your profit. So when you talk about income statement, which is in normal language we call as profit and loss statement, it will tell you about company's revenues and company's expenses, so that the company is able to calculate net profit or losses within a particular period of time. You can prepare an income statement which is called as a single step income statement, which is predicted on your screen, or you can go for multi-step income statement where a detailed statement is being prepared related to each and every item of income and expenses. Then you have a balance sheet. Balance sheet is nothing but a statement which will show the financial position of a business at a given point of time. Financial position is expressed in terms of assets and liabilities of the company. Assets are nothing but resources which are helping you to generate income. Liabilities are nothing but obligations of the company. So when you have a statement which is giving you assets and liabilities, it is called as a balance sheet. So balance sheet can be prepared in a vertical format or in a horizontal format. Both the formats are presented onto your screen. Now when you have financial planning, there are also difficulties in terms of forecasting, because all the time we are talking about predicting the future, estimating. So those estimations may not be accurate. So there is a difficulty in estimation. Then there is also difficulty in change. Once you have made a plan, can you go ahead with that plan intact? Because you may have to make a lot of changes to that plan depending on the circumstances. So difficulty in change. And there are a lot of rapid changes which happen around in terms of marketing, consumer behavior, method of production, consumer needs, wants, preferences, etc. Then there is also a problem of coordination which is there. These serves as limitation to the financial planning which is there. So in today's session, we have spoken about financial planning, where we talked what is a financial plan. We have defined the financial plan. We understood what is the significance of financial planning, and then we spoke about what all are the tools which are available so that the company can do financial planning. Then we spoke about different financial statements such as a cash budget, an income statement, a balance sheet, and then we have talked about what are the limitations of financial planning as such. So this was a part of your lesson on nature of financial requirement as a part of your unit financial planning, nature and scope. Thank you.